Welcome. I'm Nicole Cervi, and I'm joined here today by my colleague Jackie Benson to speak on our latest monthly economic outlook. So Jackie, just to summarize the data that we've seen since last month, we published our outlook in early May, we've seen that real GDP growth over the first quarter was actually revised down because we saw that real personal consumption on durable goods specifically actually contracted in the first 3 months of the year rather than posting a scant gain. And that kind of lines up with where we expect real GDP to be in the second quarter. We've seen a more modest showing in terms of spending in April. We've also seen softer growth in terms of retail sales and industrial production. Those were both flat in April. We actually saw construction spending as well decline. And so we've downward revised our outlook for real GDP growth in the second quarter as well, kind of on the note of the losing momentum it seems that we have seen in real GDP growth over the past few months. And kind of recently, when we've seen activity start to slow, we saw that the consumer price index actually came in weaker than expected in May. So maybe the weaker activity backdrop underpins some of the softness in price growth. And so in May specifically, you saw that the core CPI on a year-over-year basis actually ticked down to 3.4%. So we're getting some continual progress on inflation there. But there's some cross currents, it seems. We have a little bit weaker activity, but we've seen price growth come in under expected. But then we had a stronger than expected non-farm payroll report where payrolls increased stronger to the upside. But then at the same time in the same report, we saw that the unemployment rate ticked up a tenth of 4%, or the highest since 2022. So can you make sense of these cross currents for me? What are you seeing in this data?
Yes, thanks, Nicole. You are absolutely right that some of the labor market data specifically has painted a bit of a cloudy picture recently. So as you mentioned, non-farm payrolls did increase by over 270,000 jobs on net in May. That was the second highest gain this year, and it was also above the monthly average increase in 2023. At the same time, the unemployment rate seems to be on an upward trajectory, and we're getting farther and farther away from the cycle low hit last year of 3.4%. Other indicators also support this notion that labor demand is downshifting, at least from the record levels experienced over the past few years. So we have job openings continuing to trend lower, and that's whether you look at private sector data or government data. Consumer surveys also show that people are generally feeling less confident about the availability of jobs in the economy, and that coincides with hard data on the quit rate, kind of dropping back below its pre-pandemic level. So although the labor market is not dramatically deteriorating by any means, it does seem to be reverting back to its pre-pandemic state.
Okay, so we're seeing some labor market normalization, which I agree with, especially with some of the data that you summarize in terms of labor demand. Maybe those elevated interest rates that have been set by the Federal Reserve are starting to actually take a bite in terms of just broader consumption and labor demand. But as we know, the Federal Reserve has a dual mandate, and maximum employment is only one side of that. What are your expectations for the path of inflation this year?
Yeah, so inflation actually came in pretty hot in the first quarter. But like you mentioned, it has downshifted in recent months. So, for example, we just got two back-to-back readings of the consumer price index that came in below the expectations made by economic forecasters. In May, the core CPI, which strips away food and energy, actually posted its smallest monthly increase since August of 2021. That was especially encouraging because we saw a broad downshifting in services inflation, which needs to happen in order to get us back down to that 2% target. So moving forward, we look for inflation to continue to slow and move lower throughout the rest of the year, at least on a monthly basis. If you think about the Fed's preferred measure, that's the core PCE deflator, we have that averaging monthly gains of about 0.2% for the rest of the year. And that's lower than the beginning of the year, the first few months, where it's average monthly gains of 0.3%.
Got it. So inflation is on a downward trajectory. It still remains there, even though progress towards 2% might be a slower grind going ahead. And so when I take together inflation discernibly moving back towards that 2% inflation goal and the labor market normalizing, still kind of close to maximum employment, even though we see a subtle rise in the unemployment rate, that seems to me that Fed cuts are still on the table this year. So what is your expectation for monetary policy this year and next?
That is the million-dollar question. So the Fed actually just released a new dot plot coinciding with its June meeting. That's where FOMC participants write down their expectations for a variety of economic indicators, but also interest rates. What we saw is that members were generally split between expecting 2 cuts this year or 1 cut this year. It's really all going to depend on the incoming data. So like I said, inflation has made progress in recent months, but the 3-month annualized rate of either core CPI or the core PCE deflator still remains above 3%. So the Fed is going to want to see a series of more benign prints moving forward to gain that confidence that inflation is sustainably headed back toward target. We expect 2 rate cuts this year, so a total of 50 basis points of easing. That's 25 basis point cut at the September meeting and another at the December meeting. That said, it's going to be a close call. Like the Fed, we remain data dependent, so you'll have to stay tuned to see if we update our expectations there.
Got it. So base case as of right now remains that we look for 50 basis points of easing this year. Well, thank you, Jackie. And from all of us at Wells Fargo, thank you for tuning in to our latest monthly economic outlook.